Okay, on to Chapter 10. So Chapter 10 goes along hand in hand with Chapter 9. Chapter 9 talks about how we can use different models for evaluating the attractiveness of a capital investment. And Chapter 10 talks about what goes into those cash flow estimates that we rely upon to evaluate capital investment decisions. So it's not as simple as it sounds. And the ironic thing is, you remember back to financial accounting when, we all pulled our hair out trying to figure out how to get away from cash flows and into sort of the accrual method of accounting, where you match expenses to the periods where your revenues are, and taking depreciation and all that crazy stuff that everybody found so challenging, including me, I have to say. And now we're looking at cash, right? We're looking at cash. We aren't concerned about depreciation expense. We aren't concerned about profit. Okay? We are concerned about the actual cash that's flowing as a result of these investments that we are looking at. And so the first issue that we need to look at is this question of incremental cash flow, right? What we mean by incremental cash flow is it is those cash flows that are associated with the project itself. The cash flows that are only to do with the decision whether to move forward with this project. And so we want to look at some of these sort of I guess you could say, details about cash flows here that we haven't really looked too closely at in the past. Now, sunk costs are the first thing. Sunk costs are costs that have already been incurred. They can't be avoided. They can't be reversed. You're going to pay them. There could even be, commitments to pay, but you haven't. Okay, and so we have an example here called Cogswell Cola. Cogswell Cola is thinking about adding a new flavored cola to its product mix. We want to find the timing and the amount of incremental cash flow in order to decide whether this project is good for the company. All right, so let's look at what some sunk costs might be associated with this cola. Okay, so let's say that they've commissioned a marketing company to examine the potential market, and the money is going to be spent whether or not they move forward with this product, right? It's a sunk cost. They're not going to get it back. Whether or not they go forward with this product, it's still going to get spent. So they shouldn't consider the $25,000 fee that they're paying to this marketing company as part of their capital budgeting decision. Now, it does go into the income statement, but it's not part of the capital budgeting decision looking forward as to whether they should or should not introduce that new product. Now, another really important one, and you'll see this in your final project, the net present value of your education, is opportunity cost. Now, opportunity cost is the cash flow that you give up by selecting the project, right? So they use the word foregone, right? So it's a benefit foregone due to the company's selection of a particular project. That means you give it up, right? If you the example in our one of our homework questions is, you're looking at putting a new building on a piece of land, and you could sell that land for a certain amount of money, but if you put the new building on it, you can't sell the land. And so you have to look at the money that you're not making by selling the land as part of the cost of the project. In our example of the cola company, they plan on using a bottling machine that they purchased 5 years ago, but that's been sitting around doing nothing for 2 years. The original cost was 450 grand. All right. So on the one hand, there's nothing we can do about money that we spent on the past. But if they could sell that machine, okay, the opportunity disappears if they go ahead and use the machine. So the cost of this project have something to do with the sale, with the potential sale of that machine. But the thing is, right, that number, that 450 number, isn't the right number. Let's say that they could sell the old bottling machine now for 200,000. Right? So they originally paid 450. That number isn't relevant. But the idea that they could sell that machine is relevant. So what you have to do is figure out how much you could sell it for today, and now you have to add that in to your original cost that you're considering for the project. Okay? So that's how we use opportunity costs. Now another kind of cost, which again becomes really important, right? Here's our example of the soda, the cola. And so if they sell the new flavored cola, that might actually erode the sales of Cosmic Cola and Luna Lemon Line. Right? People might just say, well, I'm only going to buy 1 6-pack of soda a week, and so, maybe I'll buy this new cola instead of the old cola. Right? And so whenever you're looking at the revenue side of capital investments, you need to look at the change in revenue net of any erosion costs associated with it. And you do have a quantitative example of that, which will make it a little bit clearer. It's the kind of thing where you go to explain the concept, it seems pretty straight, and then you start reading through it and your eyes start rolling in your head, right? And then sit down at the spreadsheet, work it through. It's not that complicated, right? You just gotta be aware of the fact that you're losing some profits if you're eating into your other product sales. Now, on the other side of this idea of erosions, there's also, the opposite of that, which would be synergies. Let's say that you have a capital investment that will not only create more revenue and profits and cash flow from that product itself, but also by bumping up the sales of some of your other products. And so that's called synergies. Kind of magical. I wonder if it's as common as some starry-eyed entrepreneurs would want us to believe, but that's a conversation for another day. But here's our example. We see Gold Medal Sports currently has a line of baseball and softball gloves. It's now considering introducing the balls themselves, baseballs and softballs, to its product sales. And by adding the baseballs and softballs, it might increase the glove sales. Right? So it's that kind of thing. Like if you have a product that's going to increase a new product that's going to increase the visibility of your entire product line, then that's what they call synergy. And now this last example of cash flow issues that need to be considered is the question of what kind of additional cash flow is required for working capital for capital investments. And this I have seen become a pretty significant issue. It's probably not going to be brought up or something that you see in this textbook, but once I explain how it is for this Coca-Cola or Cogswell Cola example, then I'll explain where I've seen these kinds of things in my world of entrepreneurship. So we're going to have to, in order to produce this new cola, we're going to have to purchase some bottles, right? And so, in addition to purchasing all our raw materials and whatnot, we also are going to need to have some more inventory of bottles. And because of having more money tied up in inventory, right? Quite often, or that will actually reduce our available cash flow, right? Because we have more money tied up in the working capital. And again, this is the kind of thing that probably it's going to make more sense when you go through it in the example. You know, in the real world, sales, you hope, will increase from year to year, and working capital, of course, is working capital needs are going to increase each year as inventories grow. And so you may have an additional investment in working capital each year of a project, right? And so part of estimating the cash flows for capital budgeting involves the recovery of working capital at the end of the project's life when you sell off all that additional inventory. Okay, it's a technical issue. It's kind of detailed, but it is something to keep in mind. Now, where I've seen this come into play in the world of entrepreneurship is that very thing with a high growth. In a high growth company situation, sometimes working capital needs become so great because of the high growth that, you know, cash flow really is an issue. Because oftentimes startup companies are operating on very thin cash reserves, and so entrepreneurs need to be aware of their working capital needs, and have some working capital facilities in place to be able to cover those as they're growing, or else they might just grow themselves out of business, right? So that is what there is about incremental cash flow. Okay, you'll have some concept questions and some quantitative questions on this. And now we're going to go into depreciation in the next video.